Welcome back, G-Traders. Let's discuss what is going on in the financial markets. Major Wall Street indexes have been trading sideways for a few days in a row. Investors have already got used to recession fears, soaring inflation, and the Fed's aggressive monetary tightening. They need catalysts for optimism in the flood of information and economic data. Wall Street traded without a clear-cut trajectory yesterday. The major stock indexes tried to rebound, but they failed to gain momentum. So the overall sentiment remains gloomy. The Dow Jones closed 0.5% down, the Nasdaq shed 0.7%, and the S&P 500 lost 0.8% intraday to close at 4,101 points. The pre-market did not clear up market sentiment. The S&P 500 is expected to trade in the corridor between 4,060 points and 4,160 points. Fresh starts and the comments from Fed policymakers on Wednesday again discouraged the market by the lack of signals and the hints about a pause in rate hikes. Despite a decline in the job openings in the United States in April, the number remained at elevated levels. Besides, business activity in the U.S. manufacturing sector improved more than expected because demand for consumer goods is still beyond. Robust consumption and the healthy labor market prompted the conclusion that inflationary pressure will hardly wane. Hence, the U.S. Fed will not ease the pace of rate hikes. Fed policymakers Mary Daly and James Bullard confirmed that they advocate for a rate increase by 50 basis points at the next few meetings because the ultimate aim is to bring inflation back to normal rates. JP Morgan CEO Jamie Dimon warned that the challenge the U.S. economy is facing now would turn into a hurricane in the future. He called on the regulator to take drastic measures to prevent the top global economy from slipping into recession. Despite the doom and gloom on Wall Street, stock investors paid attention to a decline in oil prices. Brent crude sank more than 2% on the back of the rumors that Saudi Arabia might expand its oil output. So OPEC seems to be ready to put a lid on oil prices. Such prospects mitigate the threat of a further inflation acceleration, reduce the need for aggressive monetary tightening, and curb recession risks. All in all, this could support risky assets. At the same time, steady demand and a healthy labor market could ruin this glimmer of a hope. All those factors that halted motion in the stock market helped the US dollar to assert strength. Its index climbed to 102.40, though it's retreating now. The corridor for the index is seen between 101.70 and 102.60. Thus, the alarming forecast by JP Morgan and the hawkish Fed speakers strengthened the US dollar yesterday. Today, it's losing ground, and fresh U.S. economic data came in a mix today. Private U.S. businesses hired 128,000 employees in May, the lowest figure since massive layoffs in 2020, and much worse than the forecast of 300,000 new jobs. The service sector added 104,000 jobs, with the education and healthcare taking the lead. The IT sector fired 2,000 employees. Amid soaring inflation, the monthly employment growth approached the pre-pandemic levels. On the plus side, unemployment claims decreased unexpectedly. The number of Americans who applied for unemployment benefits fell by 11,000 to 200,000 last week, roughly in line with the consensus. It proves that the demand for a workforce remains high. The USD CAD pace trading firmly lower. Today, it's trading at nearly 1.2630 without any reversal signs. The currency pair is likely to trade in the corridor between 1.2540 and 1.2670. The Canadian dollar advanced to the strongest level in more than a month against its American rival because oil is still trading at elevated levels. Besides, the Bank of Canada pursues a hawkish monetary policy. On Wednesday, the regulator raised the target overnight rate by half a percentage point to 1.5% to stem inflation, which has jumped to the fastest rate since 1991. Besides, the central bank announced a further reduction in its balance sheet and indicated more rate hikes. The regulator is determined to push inflation to the target level. It does not rule out more aggressive tightening if it's necessary to ensure the target rate of 2%. The governor even admitted a rate hike of 75 basis points and even sharper to tame sky-high inflation. Bitcoin again reversed downwards after a failed attempt to settle above $31,700. The token is again creeping lower, so the hope for a breakout of 32,200 is waning. Today, the crypto slipped to $30,150, and thus our forecast for the corridor between 28,000 and 30,000 is coming true sooner than expected. The fragile optimism about the digital assets was ruined by Solana, the third largest crypto in terms of market capitalization. Yesterday, its price slumped by 10% in light of the news about a failure in a blockchain. The news is bearish for the exhausted crypto market. As for Bitcoin, the intraday corridor is defined between $29,300 and $30,800. To sum up, mounting pessimism about a slowdown in the global economy undermines the appetite for risky assets. Besides, market sentiment is obscured by mixed economic data. One thing is certain, the market is still trading under high volatility. Trade at a profit with the InstaForex and see you tomorrow.